Hey everyone, welcome to Talk Tickers. Today, we're breaking down Carlyle Secured Lending, ticker CGBD, and their latest earnings call. Now, this one's interesting because management is telling us one thing, a story of record activity and strength, but the stock is telling us something else entirely. So let's dig in and figure out what's really going on here. So this is the big mystery we need to solve, right? On one hand, you have the company talking up these massive platform-wide records, but on the other hand, the stock actually took a hit right after they shared the news. If we can crack that nut, we'll have a much better idea of where CGBD is headed. Okay, so whenever you've got a puzzle like this, you have to start with the hard data. Let's see how CGB's results actually shook out compared to what Wall Street was predicting. All right, so take a look at this. On the surface, things look pretty darn good, actually. That net investment income, or NII, which, is the bread and butter for a business development company, it came in right on the money, spot on with what everyone was expecting. And revenue even edged out expectations by a little over 1.5%, so no red flags so far. And as if to double down on that good news, the board went ahead and declared a 40-cent per share dividend for the third quarter. Now, that's a big deal. That's management basically broadcasting to the market, hey, we're confident, we've got the cash flow, and we're going to keep paying you, our shareholders. Okay, but here's where the story starts to get a little complicated. The company's net asset value per share, their NAV, actually dropped by 1.2% in just one quarter. Think of NAV as the company's book value, right? It's what all their assets are worth. And when you see that number start to tick down, even just a little bit, it definitely makes you sit up and pay attention. It could be a warning sign. So you've got this slightly mixed bag of results, right? Good earnings, but a drop in NAV. So what did management do? Well, they went on the offensive and really focused on telling a story about momentum and disciplined execution, even in what they admit is a tough market. And their whole story really hinged on one thing: volume. They were hammering home this point about a record $2 billion in originations across their entire platform. For CGBD specifically, they funded the highest amount since their IPO. The message they were trying to send was crystal clear. Yeah, the M&A market is slow, but we're out here taking names and getting deals done. We are ready for the second half of the year. And this quote from the CEO, Justin Plough, just sums it all up perfectly. He's not really talking about last quarter. He's pointing everyone's attention to the future. He's basically saying, don't worry about the tight spreads right now. Look at the pipeline we're building for Q4. Okay, so management laid out a pretty compelling story. But, at the end of the day, the market is the final judge. So how did investors, the people with real money on the line, actually vote? Well, the verdict was pretty unambiguous. The day after the earnings call, August 6th, the stock dropped about 1%. And it wasn't on some sleepy, low-volume day either. Trading was heavier than usual. Now, it's not like the stock fell off a cliff, but it was a clear signal that investors were not buying what management was selling. And this slide right here really nails the whole conflict. It's a tale of two stories, isn't it? On one side, you have management talking up their record deals and stable dividend. But on the other side, you've got the market saying, that's great, but where's the real growth catalyst? They're looking at that shrinking NAV and getting worried about future earnings getting squeezed. So let's really dig into what's spooking investors. First off, that dividend coverage is paper thin. I mean, earning 39 cents and paying out 40, you can't do that forever. Then there's that NAV erosion. Management might blame it on a few specific things, but it still makes you wonder about the overall health of the portfolio. And when you throw in the fact that the stock has been a serious laggard all year, well, investors are just left scratching their heads and asking, why should I own this? Okay, so we've heard from management, we've heard from the market. Now let's put it all together. What's our take on what's going to happen between now and the next earnings call? So for us, this all adds up to a market perform rating. And here's the thinking. We think that net investment income is going to hold steady. It'll probably be fine in the short term. But that NAV, that's going to stay under pressure. For the stock, that means it's likely stuck. You've got the dividend yield putting a floor under the price, but that discount to its book value is going to act like a ceiling. Look, the company is running its business just fine. But right now, we just don't see the big spark that's going to make it outperform the rest of the sector. But if you're looking for a more, shall we say, aggressive play, here's an idea. A pair trade. You'd go long CGBD and at the same time short a BDC sector ETF like BIZD. Now, this isn't a bet that the entire private credit market is about to take off. No, this is a much more specific bet. It's a bet that Carlyle's platform,
Their deal sourcing machine is just plain better than their competitors. You're betting that they can generate their own success, idiosyncratic alpha, even if the broader market is choppy. It's a bet that CGBD can out-hustle the average.
And as always, we have to end with this very important reminder. This is not financial advice. Make sure you do your own homework before making any investment decisions.